Hi everyone. In this video, we are going to discuss option Greeks. I have already posted a video earlier on option trading, basic idea, basic details of option trading for all the newcomers and those who have no idea about options. So in that video, I have said clearly that we will be posting some other videos on the same subject. Hope you have already seen the other video. So in this video, we are going to discuss option Greek. What is option Greek and how this is affecting options premiums? So you know already what is option premium. So option premium is always changing. The main factor that decides the price of or the value of premium is the underlying asset. So the price of option premium or the value of premium is deriving from its underlying assets value. Whenever that assets value, whether it is share or index, the premium is also changing accordingly. For example, if you are buying Tata Motors option call, whenever the price of Tata Motors shares are changing, whether it is going up or down, the same movement is happening in its premium value. So if you are buying call option, you are expecting the share price to go up. So your premium will also go up and you will make profit. When you're buying a put option, Tata Motors, then you are expecting a down movement in Tata Motors price and also you will get profit in your put call. So we have to analyze what are the other factors that affect the premium price. So one of the very important factors affecting the premium price is option Greek. So what is option Greek or what are the Greeks and how this is going to affect the premiums performance, how it is affecting the option premium. This is what we are going to discuss. So let's see first what are the Greeks. So there are four main option Greeks. They are delta, gamma, vega and theta. So in this video we are not going to discuss all these four option Greeks. It is always better to go in detail and also in very simplest form. We don't have to go to the calculations and get confused. I already said this is for the beginners or those who want to understand what is delta. So let's go and discuss delta only in this video, and in the coming videos we can discuss and we can go to the details of gamma, vega and theta. So delta measures the change in an option premium's value resulting a change in the underlying asset. So it means delta measures the rate of change of an option premium whenever there is a change in the underlying asset. Let's take the same example of Tata Motors. Tata Motors is trading at 595 rupees. You are buying call option, strike price Tata Motors 600. It's almost like ATM at the money. So in this case, premium, let's say it is 100 rupees. When the share price of Tata Motors moves from 600 to 605, the premium will get increased. We bought it at 100. When Tata Motors was at 600. Now Tata Motors is at 610. So the premium would definitely go up from 100 to 110 or 109 or 111, whatever it is. So this increase in that premium value, we should know how this is being increased or even decreased if the other way, if price go down. So here, what is the role of delta in it? Delta will decide the rate of increase. What is the percentage of increase when the price of Tata Motors moves? We can see here, delta will decide the rate of increase in an option premium. In the money, this is what is ITM. In the money, strike prices are having high delta, and out of the money strike prices are having low delta. In our previous video, we have clearly mentioned premium of an option contract is based on its strike price. Here, if Tata Motors is trading at 600 and you are buying a call option at 600, then that strike price is at the money. So the premium will change very positively if it moves up. Why? Because delta is high there. Because in the money, at the money options are having high delta. If you buy a strike price of 675 Tata Motors, it means Tata Motors should go above 675, then only you will make profit. So when you buy 675 call option, the premium would be very less and the rate of increase also would be very less. In the coming slide, we will go and see some examples. See, let's go and see the definition. Any increase in an underlying asset's price will immediately affect the premium value. Example, if your strike price is in the money, then a rate of increase would be 0.8, but an out of the money strike price would only be at 0.2%. So here, if you take Tata Motors example, if you buy call option strike price 600 because it is trading at 600 or it is trading at 605, you are buying 600. 600 is in the money then. Then when it is moving up, the share value of Tata Motors is going from 610 or 600 to 615, 620. The premium will be increased at 0.8%. But if you are buying out of the money strike price, that is 675, your premium value would be less, but when the price moves up, the rate of increase is only 0.2. So you are not going to make profit very fast. Otherwise, the underlying asset, that is Tata Motors, should fly from 610 to 650 or 60 or 70 or 80 very fast. Then your OTM price, that is becoming ATM, at the money or in the money, if it goes very fast, very high. Hope you understood that concept. Let's go and see the next slide. So positive delta for buy call option. Call premium will increase when underlying assets value increases. Bullish view. Negative delta for buy put option. Why negative delta is good for put option? Because when you buy put option, your view is what? Negative. It means either the share price or the index value is going to come down. Bearish value. Okay, so for bullish value, you need positive delta, and bearish value, you need negative delta. When you look at the chart, if it is 0.8 for any strike price, that is positive, and close to 1, that is good for making profit first. Let's see these 3 points. Delta tends to increase closer to expiration for near or ATM options. So the delta, the rate of increase, tends to increase when the strike price come nearer to ATM. So you bought 600 call option. The price of Tata Motors is at 590. You bought 600 call option. So this 590 share price is increasing to 600 levels. Then your premium will jump. So delta is increasing there. Also the second point, delta is further evaluated by gamma, which calculates the rate of change. We have seen in the first slide there are 4 option Greeks. Delta, this is what we are discussing now, and the second one is gamma. So this gamma is also will affect delta. How? Delta is further evaluated by gamma, which calculates the rate of change. So at what rate a premium should increase, this is decided by gamma. So gamma we will discuss in the next video. So let's concentrate now on delta only. So delta can also change in reaction to implied volatility. Normally term is IV. So IV shows market volatility. High IV comes normally when markets fall. You must have heard that India VIX implied volatility. There are many terms. What does it mean? It is calculated in a way that whenever there is a change in stock market, especially if there is a big fall, the implied volatility will go up. So whenever it goes up, it is not good for the market, and that will also affect the premium prices. So delta can also change. For example, if you sell an option, you are expecting the premium to come down, but whenever there is IV increase, it is not going to come down fast. So you have to wait. So it is not good for option sellers when it increases. But it is good for option buyers in a different, because we don't have to discuss that details now. Now here we are discussing only a general idea about delta. Even you don't have to calculate anything when you buy an option. You just need to look at the chart. And those who are experienced, by experience you will learn at what strike price is delta is good and what is the best strike price to play with. So we have to understand that gamma is also affecting delta, also implied volatility, that is also affecting delta. And when it closer to expiration, when it is going towards the expiry of the contract or at the money options, that is also affecting delta. Delta values closer to 1 and -1 provide the highest levels of traction. So positive is for call buy and negative is good for put options. Positive delta for long buy and a negative delta for short means selling market assumptions. So giving you another example, like when you buy deep out of the money options, delta is small and underlying asset should increase maximum to generate some profit. So deep out of the money, what does it mean? For example, Tata Motors is trading at 600 now. If you are buying Tata Motors contract strike price is 750. It is deep out of the money. Means the strike price is far away from the actual price of Tata Motors. Actually 600 only, but your strike price is 750. If you buy this option contract, delta is very small there. Why? Because it is far out of the money. It is not at the money or in the money. So delta is very small, and even if the price increase from 600 to 615, your premium increase is negligible. You're not going to make profit there. Otherwise, the underlying asset, that is Tata Motors, should increase drastically to 700 levels. Normally that is impossible in the market, and you can't hold an option contract for a long time. Here there is an expiry date, and also when you buy an option, it is getting depreciated day by day if the price remains same, if the share price or the index is in the same situation. So it is always better to buy option with high delta and you square off, or you make profit immediately, otherwise you square off and clear the position. Here there is a chart shows a real example. Let's see how this works. Nifty spot 8400. Nifty is trading at 8400. Right now Nifty is 19500. This is only an example. So Nifty is at 8400. So there are two option contracts. One is at 8300 strike price. So 8300 Nifty 8300 CE call option is ITM, in the money. Why? It is less than actual price. So the spot price, the current actual market price of Nifty is 8400 and you are buying 8300 call option. As it is 8300 less than the Nifty actual price, it is called in the money. Delta is 0.8 and premium is 105. The second contract is 8200 CE. It is deep in the money. It is both are in the money, but it is just in the money, only 100 less. But 8200 is deep in the money. It means you are here when you buy 8400 Nifty call by, your view is that Nifty will go above 8400. So when you buy 8300, it is already at 8400. So the delta is very high, premium is also high. When you buy 8200, it is again was already at 8400 levels. So when it increases to 8450 or 500 levels, the rate of change is very high. So this one you understand. If you understand this example very well, immediately you will understand what is delta and what is its role in fixing the price of an option premium. So change in underlying is 100 points. So Nifty moves to 8500. Here you bought these two options. Okay, then after Nifty's value increased to 8500. So 100 points increase. It was at 8400 when you bought these two options. Now it is at 8500. So let's see what is the actual scenario. How options premium is calculated, or premium is being calculated. So change in premium for option 1. Option 1 is at 8300 strike price. 100 your option into 0.8. So here 80 rupees premium. So you bought it at 105. So 105 plus 80, your premium is now 185. You made a profit of 80 rupees here. And percentage change is 76.19. So in the second option, your rate of increase, the premium increased is 100 rupees. Why? It was 1. It was not 0.8. It it was 1. So increase is what? The actual Nifty price increase 8,400 to 8,500, that is 100. So here 100 into 0.8, the rate is 0.8, so 80. But here 100 into 1, so the premium is 100. New premium for option 2 is what? You bought it at 210. So 210 plus this increase is 100. So your premium reached 310. So where you make more money? You make more money here in the second option. So what is the conclusion? In terms of the absolute change, the number of coins, the deep in the money option scores over the slightly in the money option. So slightly in the money is this. This is deep in the money. Clear? So this is one of the best examples. We discussed earlier out of the money. So here if you choose Nifty spot 8,900, that is out of the money. But 8,200, when it is trading at 8,001, you are buying 8,200 is deep in the money. And 8,300 is slightly in the money or in the money. Clear? If you read this example and understand the calculation, you can take a screenshot or just pause and note it down why deep in the money is making more premium, what is the reason and how it is being calculated. Then you will understand how option Greek delta is affecting the premium. It is very simple that the rate of increase is 0.84, slightly in the money, but when it comes to deep in the money, the rate is 1. So you get full premium here. If you buy, for example, 8,400 call, even 8,200 will make more money than 8,400, and 8,300 will make more money than 8,400 when this price goes to 8,500. Clear? So next video will discuss gamma and other Greeks in the coming videos. Thank you for watching. Wishing you all success.